probably heard of this thing, right? The VIX? Especially when the market starts getting a little crazy, you'll hear the news anchors call it the fear gauge. It's this one single number that's supposed to tell us how the entire market is feeling. So let's dive in and really unpack what the VIX is and what it tells us about the anatomy of fear and risk in the financial world.
It's a powerful nickname, isn't it? The fear gauge. It makes it sound like this one index can somehow, I don't know, read the collective mind of millions of investors. But how does it actually do that? And is fear even the right word for what it's measuring? That's the big question we're going to tackle. Okay, before we go any further, let's get one thing straight, because it's the biggest misconception out there. The VIX doesn't cause volatility any more than a thermometer causes a fever. It's just a reflection, an indicator of the demand for something like portfolio insurance. This is absolutely crucial. It measures the symptom. It doesn't create the illness itself.
So if it's not some kind of mystical fear detector, then what on earth is it? Let's pull back the curtain and get to know the formal identity of this famous index.
Here it is, the official definition. The VIX is a real-time index showing the market's expectation of volatility over the next 30 days. And it figures this out by looking at the prices of options on the S&P 500, which, is the main benchmark for U.S. stocks. The two magic words here are expectation and forward-looking.
And this slide right here illustrates maybe the most important concept of all. The VIX isn't a report card on what the market did yesterday or last week. That's a different thing called realized volatility. Nope, the VIX is a forecast. It's what the collective market thinks is going to happen over the next month based on how they're pricing options. It's all about the future, not the past.
Okay, so it's a forecast that comes from option prices. But how does that actually work? Let's pop the hood and see how this thing is actually built, without getting totally buried in complex math.
Conceptually, you can boil it down to these 4 steps. First, the Chicago Board Options Exchange basically grabs a ton of S&P 500 option prices. We're talking both puts and calls. Second, it uses a formula to kind of work backward from those prices to figure out the implied volatility for each one. Think of it like reverse engineering the price to find the secret ingredient. Third, it mashes all those different volatilities together. And finally, it standardizes that combined number into a single, clean 30-day forecast. That final number times 100, well, that's the VIX. The VIX has actually been around since 1993, but the version we all talk about today was really born in 2003. That's when they updated it to be based on the much broader S&P 500 index instead of the S&P 100. And that was a huge change that made it a much more robust and accurate measure of the whole market. Soon after that, it became a tradable thing itself, with VIX futures and options hitting the scene. Now for the really fascinating part, how the VIX actually behaves in the wild. It doesn't treat good news and bad news equally, not at all. And this is what really cements its reputation as a fear gauge. I mean, just look at this chart. It tells the whole story, doesn't it? See how every single time the black line, that's the S&P 500, takes a nosedive, the blue area for the VIX just skyrockets? During big crises like the '87 crash or the Asian financial crisis, you can't mess this pattern. This inverse relationship is the absolute defining characteristic of the index. And we can actually put a number on that relationship. When the S&P 500 drops by just 1%, the VIX tends to jump by almost 4.5%. But here's the kicker. The reaction to a positive move is much smaller. The market's reaction to potential loss, to fear, is way stronger than its reaction to potential gain or greed. This asymmetry is exactly why it gets that nickname. And hey, don't just take my word for it. Listen to the guy who literally invented the thing, Robert Whaley. He says it himself. It's a way better barometer of fear than it is of greed. When the market goes down, investors rush to buy portfolio insurance, put options, and that drives up their prices, which in turn drives up the VIX. That same kind of frantic buying just doesn't happen during a rally. Okay, so we know the VIX is a forecast, but is it a good forecast? And what does the difference between its prediction and what actually happens tell us? This leads to this really cool idea called the prediction premium. So check out this number, 4.09%. What is this? Well, over the last 35 years or so, this is the average amount by which the VIX has overestimated what the market's volatility would actually be. It's basically the insurance premium that investors, on average, are willing to pay to be protected from things going haywire. This chart makes that premium crystal clear. On the left, you've got the average VIX reading, around 19.6%. And on the right, you have what the average actual volatility turned out to be, which was about 15.5%. That gap between what we expect and what we get, that's the volatility risk premium, and it has been surprisingly consistent over time.
So why does this premium even exist? Well, a big part of the answer is how the VIX acts during a panic. It's kind of slow on the uptake at first, and then it freaks out and overreacts, spiking way higher than what ends up actually happening. This pattern, underreaction followed by overreaction, helps explain that consistent 4% premium. All right, we've covered a lot of ground. What it is, how it works, how it behaves. So what's the big takeaway? What's the best way to think about the VIX? I think it plays two distinct but equally important roles for anyone watching the markets. It's simple, really. It's both a barometer and a ruler. The barometer gives us that real-time gut check on the market's mood, the anxiety, the uncertainty. The ruler, on the other hand, gives us a hard number, a quantitative tool to actually measure the potential size of that risk. The barometer is answering the vibe question. What's the collective mood out there? Is the weather calm or is a storm brewing? The ruler answers the quantitative question. Okay, if that storm hits, how big could it actually be? It helps us measure the probable range of what the market might do next. It's the difference between feeling and forecasting. See? So ultimately, when you move beyond that simple fear gauge headline, you see the VIX for what it really is, an essential instrument for navigating uncertainty. It's not a crystal ball, no way, but it is a pretty sophisticated compass that's built from what real people are doing with real money in real time. So let's end with this thought. The VIX is never going to tell you for sure what the market will do tomorrow. It just doesn't work that way. But what it does, better than almost anything else, is measure our collective uncertainty about that future. It puts a number on our questions. And the most important question it leaves us with is always, what is it telling us right now?